People don't buy houses, they buy belief in the future, in security, in timing. And when that belief is shaken, everything slows down. Right now, New Zealand's housing market is shifting, not with a bang, but with a murmur. Friend of the show, the popular Kelly Eckhold returns, Westpac's chief economist. Prices are rising, activity is creeping back, and behind the fear, quiet momentum. If you like making money rather than watching everyone else do it, hit that subscribe button because the numbers don't lie. More investors are getting their New Zealand housing and real estate intel in 2025 from this show than any other YouTube channel. Kelly, what does Westpac mean by gradual recovery, and how should investors interpret that?
Yeah, I think we have to kind of think about it as like a classic Glenn Turner kind of like test cricket innings, I suppose. Gradually, you start by hitting the ones and twos, basically focusing on getting the full face of the bat on the ball. You don't go out there and start hitting boundaries from the second or third ball, as is quite common now in 2020 cricket. So for us, that means positive growth for the first half of the year, but probably below trend. So that's probably quarterly growth in the 0.4, 0.5 range for each quarter. And then when you get to the second half of the year, you get to about trend, which is probably closer to 0.7 or 0.8. And if things go well, you might get a little bit better than that, really.
And why do you think buyer sentiment is still so cautious, even as prices and sales activity stabilizes?
I think there's a few things at play there. Firstly, it's pretty early in the cycle. Interest rates started getting cut back in August, where say 9 months or so on now, remembering that quite a lot of the big interest rate cuts really came towards the end of last year and at the start of this year. So for many people, they're not really feeling it as much yet. For example, the statistics that the Reserve Bank issued a few weeks ago showed that the total amount of mortgage interest that people are paying has actually finally declined for the first time in a while, but it's a pretty small decline. And by our projections, it'll pick up quite considerably even as we go through the next 6 months or so. That's just that process of everybody going on to a new lower fixed rate mortgage. The other thing that makes people cautious reasonably is that the labour market is still quite weak. We got some better news in the last couple of weeks because the unemployment rate didn't rise. It stayed at 5.1%. So that's kind of good news. But the underlying picture there is one where the amount of new jobs available is pretty flat, really. There might be a smidgen of growth, but it really is just a smidgen. At the same time as the workforce continues to grow, as migration comes in, just the natural kind of progression of life. So it means that unemployment rate is still going to be drifting up, probably for another, say, 6 months yet. And while that's going on, obviously that's going to make people a little bit leery of the future, because if you've got a job, you're fine. But if you lose a job, then it might take you a little while to find another one. So that'll keep people's spending appetites in check a bit. I guess the other thing that's been going on is what's going on out there in the world, and the antics of Mr. Trump and his government. There's been a lot of really bad news in the economy in the last month or so, but then also more latterly, there's been quite a lot of better news as well. It'd be reasonable, I think, for people to say that they're not really quite sure how that's all going to shake out, and that may also generate a little bit of conservatism for a while yet.
A lot of things to pick up on there. But before we get back to interest rates and affordability, let's go back and focus in on the unemployment. I saw the chart from your recent report. The unemployment rate for 3 to 12 months of being unemployed is just skyrocketing. People are staying unemployed for longer.
That's right. So that's been the interesting and actually a little bit unusual feature of this cycle. And I think there's both good and bad news there. The good news is that if we look at the proportions of people that have been put out of work just for the last few months, we see that's relatively low. And what that tells you is that not lots of people aren't being put out of work just in the recent past. The issue is, I think, that we saw the labour market slow really rapidly between about April and July last year, and perhaps even going through into September when a lot of the public sector workers got started to get laid off after the last budget was agreed. So what that meant is that there was quite a bit of extra people made unemployed, probably about 6 or 9 months ago, there or thereabouts. And they're still unemployed because, as I mentioned before, the flow of new jobs available is not that great. So if you've been turfed out of a job, it is a little bit hard right now to get into one. So that's the bad news. Overall, though, what we've noticed is that it's probably a bit better than some of the other big up cycles in the unemployment rate, because usually you find that all of these parts of unemployment are correlated together. So the percentage of people that have been unemployed for a while is going up, and the percentage of people that have been turfed out of work just in the recent past is also rising at the same time. The fact that that latter one isn't, I think, probably gives you some optimism that when jobs growth picks up, when demand for labour picks up, that unemployment rate can probably stabilise and start falling reasonably soon.
Just a reminder, your competition has already subscribed to the fastest growing property and investment channel in New Zealand. That means they're getting the insights first, making the moves first, and locking in profits while you're still debating whether to click a button. Be smart, subscribe. If we go back to how these interest rate cuts are affecting this affordability for home buyers and for potential home buyers, what's the data showing us?
Well, it's certainly the case that the boost to household disposable incomes that borrowers are getting in this cycle compares favourably to the other cycles where interest rates have been cut in the past. As I mentioned before, we've still got a little bit of time to wait before most people actually see those readies in their back pocket. There's going to be a lot of people that will be refinancing their mortgages as we speak and as we go through the next 3 or 4 months, if the Reserve Bank's figures are any guide. But once that process is complete, we estimate that the average household might be getting an extra 4% of disposable income, roughly, in the back pocket. And that's just paying less for interest, basically. And that is actually quite large compared to most of the other cycles. The one that was larger was back in the global financial crisis, but that was actually a much worse situation for the economy than we're in now. So I think that should give you some optimism that from an affordability perspective, things are probably improving there.
So borrowing power is going to increase over this year because the interest rates coming down. Is this affordability wave is kind of coming back behind it? The confidence will come back into the market, and we'll see more people interested in buying property, and hopefully that's reflected in the card spending data as well, or not yet?
Yeah, so I mean, we're sort of seeing it in the house price data, where house prices have risen for 6 months consecutively now. We see it in the speed at which it takes to sell a house, which seems to be speeding up. Like it was sitting closer to 50 days, and in the data that we got this week, it was just under 44 days. So that was pretty encouraging. Consumer spending has been a bit bumpy on a month-to-month basis, and it didn't grow very much at all in the month of April. So we're probably looking forward to growth in that as we go further through the year. I will kind of caution you a bit that focusing on some of the monthly data in March and April is a little bit fraught, simply because we've had a few holidays shifting around, which makes it quite hard to adjust for the data. And of course, we have to remember that there's been all these scary stories on the TV for most of the last 6 weeks or so, talking about trade wars and tariffs and terrible things that are going to happen to prices. All of these sort of things you could easily imagine would just pin people's spending appetites back a little bit for a while.
Yeah, that March April transition where there's a lot of taxes, different taxes due, a lot of public holidays. It's quite tough for the small medium businesses with all those pay cycles and holidays. So what signals should smart investors be paying attention to right now? Is it OCR predictions, interest rate changes, GDP stuff? Where do you point people?
I think I've been pointing people to the factors that you can probably expect to be more enduring as we go through the year. So the enduring factors are the fact that interest rates are obviously falling and are quite low now, and by most forecasts probably have a little bit further to fall. And the other enduring factor is that the commodity prices that exporters are receiving continues to run on pretty strong. Um, so the negative factors really are the uncertainty that's going on around there at the moment about what's going on in the world. But the point I've been making to customers is that uncertainty is a transitory factor. It'll be there for a while, but eventually it will resolve. The structural factors, the lower interest rates, the higher commodity prices, still resilient tourism market, these are factors that are likely to be with us here for a while and ultimately should support growth.
Well, we all sit on the edge of our seats waiting for somebody to hit a boundary, and we have to be patient in Test cricket, and we've become accustomed to that 2020 game. So appreciate your insights today, Kelly. Kelly Ecole, Chief Economist, Westpac. A reminder again, money moves fast, and the investors making the most of it are here. This is the fastest growing property channel in New Zealand for a reason. If you don't subscribe now, just know that someone else is already using this knowledge to make their next deal while you hesitate.